Did you know that the window sticker on new EVs doesn't tell the whole story? Did you know that you can reduce your federal income tax burden by up to $7,500 when you buy a new plug-in vehicle? If you knew about the tax credit, do you know how to file for it? Well, it's your lucky day because that's what this video is about, so let's get started. The first thing to determine is which vehicles qualify for the tax credit. For that, we'll start at my favorite place on the internet, my website, the EV-angelist.com. On the right side of my website, scroll down and find a blog roll, a collection of links for visitors to use to access important information. Scroll a little further down on the blog roll and you'll find the government section. In that section, you'll find a link to the federal tax incentives. Just click on that and you're taken to the federal tax credits for all electric and plug-in hybrid vehicles page of fueleconomy.gov. Scrolling down, we can start to see a list of the eligible vehicles, and we can also see that they don't all get the same income tax credit. Notice, for instance, the Audi listing. It shows the 2016 to 2018 A3 e-tron was not a fully electric vehicle. It has a yellow label showing PHEV for plug-in hybrid electric vehicle. It was based on the Audi A3 sedan. My Chevy Volt is a similar type of plug-in vehicle. It plugs in and has a battery pack, but it also has a gasoline engine acting as a range extender in case I need to drive further than the range of the battery pack. Although my Volt qualified for the full $7,500 tax credit, the Audi A3 e-tron did not because it had a smaller battery pack size. The smaller the battery pack, the lower the tax credit. However, starting with the 2019 model year, the e-tron became a fully electric large SUV with much greater range and no gas engine to extend its range. Due to this, it qualified the 2019 e-tron SUV for the maximum tax credit of $7,500. This page allows us to shorten the list of vehicles by selecting the manufacturer in which we're interested. Here I've selected Chevrolet to show you how to interpret what you're seeing. There are 3 columns with the headers full credit, 50%, and 25% under the term phase out. Well, what's this about? Well, back when the income tax credit for plug-in vehicles was passed, the legislature created a limit on the number of vehicles from each manufacturer able to qualify for the tax credit. That limit was 200,000 vehicles sold. Once the limit was hit by a manufacturer, that manufacturer would have the remaining months of the quarter in which the limit was achieved, plus 1 more quarter before the phase-out would begin. Here's an example of what I mean. General Motors, the parent company, as Chevrolet, GMC, Cadillac, and others, sold their 200,000th plug-in vehicle in November of 2018. From that date until the second quarter end following the date, the full $7,500 credit stayed in effect. This meant consumers were able to know exactly when the government incentives would change. They did not have to keep watch for the 200,000th vehicle sale or wonder if the plug-in vehicle they bought was before or after the 200,000th was sold. The date when the tax credit amount changed for GM was April 1st, 2019. At that point, the $7,500 credit was cut in half to $3,750. That credit amount would remain in effect for the next 2 quarters and would have its value halved once again to $1,875 on October 1st, 2019. The credit would remain at that level until April 1st, 2020, and on that date, the tax credit would not exist for any General Motors plug-in vehicle. That final limit, by the way, was hit by Tesla Motors on January 1st, 2020. In other words, as of this writing, no Tesla motor vehicle qualifies for any federal tax credit, and GM vehicles will lose the tax credit entirely on April 1st, 2020. The next company in line to hit the limit is Nissan Motors, manufacturer of the Leaf. My issue with the phase-out is that it penalizes the manufacturers that pioneered electric transportation in the modern era, namely Tesla, General Motors, and next up Nissan. The manufacturers who played it safe, waiting to see if EVs would become viable products, have a pricing advantage now. Unfortunately, Two companies being penalized are not only pioneers, they are American manufacturers. That being said, don't avoid a manufacturer just because they no longer qualify for the tax credit. These companies understand their position, and some have made price concessions to make up for the loss of the tax credit. Well, I'll get off that soapbox for now. As we scroll down the list, we can easily see two right columns hold dashes instead of dates because those manufacturers have not sold their 200,000th plug-in, and therefore the full tax credit is still in effect for their vehicles. You might be surprised to find that this list shows 119 EVs and hybrids have already qualified for this tax credit, and there will be lots more added in the next couple of years as new plug-in vehicles come to market. Just to be clear, this is a tax credit, not a tax deduction. In other words, you get the entire amount taken off your income tax for the tax year in which you bought your plug-in vehicle. If it was just a deduction, you might only get back $1,500 of a $7,500 deduction. A deduction is deducted from your income, which is then taxed. A tax credit is subtracted from your income tax after all your deductions have been accounted for. The downside to this program is that, due to the tax credit being limited by your tax burden, it's possible you don't have enough income tax burden and therefore won't get the entire amount. I saw this most commonly with retirees and people at the beginning of their career. Both groups typically have lower incomes, which means lower income taxes. If your entire tax burden is only $4,000 per year, the most you can get credited back to you is $4,000. There is no rollover to the next tax year. Those with lower income tax burdens typically lease their plug-in vehicle because the leasing company, who is the actual buyer of the vehicle, gets the tax credit. Many of those leasing companies use that tax credit to bring down the monthly lease payment for their customers, granting the lessee more of the value of the tax credit. To see if you can reasonably expect to get the entire tax credit, pull out last year's 1040. Look for line 16 on the second page of the form. This was your total tax last year. It has nothing to do with owing a tax at the end of the year or the government owing you a refund. This is your total tax burden. If the number on last year's line 16 is greater than $7,500, or the tax credit for whatever plug-in vehicle you're considering, there's a good chance you'll qualify for the entire amount. One thing that can change this is if your income or deductions have changed wildly in the current year. And of course, I am not a tax accountant or a tax advisor, so please double-check your specific situation with your tax preparer. Once you know you can get enough of the tax credit to make the purchase of a plug-in vehicle attractive, it's time to start EV shopping. The next spring, as you're getting ready to file your income tax return, you'll need a couple of additional forms. They are Form 8936 to let the IRS know exactly which vehicle you purchased, and Schedule 3, where you'll list your tax credit. Here's how that works. With Form 8936, notice there are two columns, making it easy to go ahead and buy two EVs instead of just one. In fact, you can collect the tax credit for as many plug-in vehicles as you want, as long as the total amount of the tax credits does not exceed your tax burden. After you've filled in the information on your plug-in vehicle or vehicles, you'll total the amounts in this lower section here. The amount shown on line 23 of this form is then transferred to line 6 on Schedule 3, Additional Credits and Payments. Then you'll total lines 1 through 6 and place the result on line 7 of this form, Schedule 3. The contents of line 7 on Schedule 3 are then transferred to line 13B of your 1040 tax form. The rest is pretty straightforward. But one last bit of advice. When you receive your refund for the tax credit, pay it into the car loan if you have one. Everyone else knows they can get up to $7,500 off their taxes by buying a plug-in vehicle. So your plug-in will instantly depreciate by that amount. Due to this, some people think plug-in vehicles depreciate much faster than a normal car. but you're not really paying that total amount. You got an income tax credit. So you actually paid the sale price minus that tax credit amount. And if you start plotting depreciation from that original price, you'll see plug-ins depreciate pretty much like any other car, or about 50% over 3 years. I hope you found this video informative. If you live in the state of Texas, I will show you how to collect the Texas EV and plug-in hybrid rebate of $2,500 in a separate video, so stay tuned.